The stock market. It's a force of nature, a relentless tide of money that has shaped economies and empires for centuries. It's a place where fortunes are made and lost, where dreams are realized and shattered in the blink of an eye. From its humble beginnings in the coffee houses of 17th century Amsterdam, the stock market has evolved into a global behemoth, a complex ecosystem of buyers and sellers, investors and speculators, all vying for their piece of the pie. The history of the stock market is a story of booms and busts, of innovation and regulation, of greed and fear. It's a story that reflects the very best and worst of human nature. It's a story that continues to unfold before our eyes every trading day, every minute, every second. The market's impact on our lives is undeniable. It influences the prices we pay for goods and services, the jobs we have, the homes we live in. It can be a source of great wealth and prosperity, but also a catalyst for economic hardship and social unrest. Understanding the history of the stock market is not just about understanding the past. It's about understanding the forces that shape our present and our future. The story of the stock market begins in the Netherlands, a nation built on trade and exploration. In 1602, the Dutch East India Company was formed, a pioneering enterprise that would forever change the face of global commerce. To finance its ambitious voyages to the East Indies, the company issued shares of stock, offering investors a stake in its potential profits. This innovative approach to raising capital proved to be a resounding success. Soon, a bustling marketplace emerged in Amsterdam, where shares of the Dutch East India Company and other joint stock companies were bought and sold. This was the world's first true stock exchange, a precursor to the financial hubs that would later emerge in London, Paris, and New York. These early stock exchanges were informal affairs, often held in coffee houses or other public spaces. But the principles of supply and demand were already at work, driving prices up and down based on investor sentiment and the perceived value of the underlying companies. As the volume of trading grew, so too did the need for more formal rules and regulations. The establishment of these early stock exchanges marked a pivotal moment in financial history. For the first time, individuals could invest in companies engaged in far-flung ventures, sharing in the risks and rewards of global trade. This new system of finance would fuel the growth of empires, spark industrial revolutions, and shape the course of human history for centuries to come. The Industrial Revolution of the 18th and 19th centuries brought about unprecedented economic transformation. New technologies and manufacturing processes emerged, creating new industries and fueling a surge in global trade. The stock market played a critical role in this transformation, providing capital for railroads, factories, and other industrial enterprises. The rise of industrial capitalism created immense wealth, but it also brought about new challenges. The stock market, once a relatively small and exclusive domain, became increasingly accessible to the general public. This democratization of finance had its benefits, allowing more people to participate in the growing economy, but it also introduced new risks. The Panic of 1873, triggered by the collapse of a prominent investment bank, highlighted the dangers of leverage and speculation. Investors who had borrowed heavily to buy stocks found themselves wiped out when the market crashed. This financial panic had a ripple effect throughout the economy, leading to widespread bank failures and a prolonged economic depression. Amidst the chaos and uncertainty, figures like J.P. Morgan emerged. Morgan, a powerful financier, recognized that the stability of the financial system was essential for the health of the broader economy. He used his influence and wealth to orchestrate bailouts and restore confidence in the markets. Morgan's actions demonstrated the growing interconnectedness of the financial system and the outsized role that powerful individuals could play in shaping its fate. Section 4. The Roaring Twenties and the Crash that Followed. The Roaring Twenties was a period of unprecedented economic prosperity and social change. The stock market, fueled by technological innovation and a wave of consumer spending, soared to new heights. Investors, eager to get in on the action, poured their money into the market, driving prices ever higher. The rise of margin buying, which allowed investors to purchase stocks with borrowed money, amplified both the gains and the risks. As stock prices climbed, so too did the level of speculation. Investors, caught up in the euphoria of the bull market, ignored warning signs and continued to buy stocks at inflated prices. The party came to an abrupt end in October 1929 when the stock market crashed, wiping out trillions of dollars in wealth. The crash, triggered by a confluence of factors, including excessive speculation, loose credit, and a decline in industrial production, marked the beginning of the Great Depression. The stock market crash of 1929 was a stark reminder of the inherent volatility of the markets and the dangers of unchecked speculation. It exposed flaws in the financial system and led to calls for greater regulation. The crash would have a profound and lasting impact on the global economy and on the lives of millions of people. Section 5. Regulation and Recovery, Restoring Faith in the Markets. The stock market crash of 1929 and the ensuing Great Depression exposed major flaws in the financial system. In the aftermath of the crash, policymakers around the world implemented sweeping reforms aimed at restoring faith in the markets and preventing future crises. In the United States, President Franklin D. Roosevelt signed into law the Securities Act of 1933 and the Securities Exchange Act of 1934. These landmark pieces of legislation established the Securities and Exchange Commission, or SEC, a federal agency tasked with regulating the securities industry and protecting investors. The Glass-Steagall Act, passed in 1933, separated commercial banking from investment banking, preventing banks from using depositors' money for speculative investments. This act, while controversial, was designed to reduce risk in the financial system and protect consumers from the consequences of reckless banking practices. These reforms, along with other government programs aimed at stimulating economic growth, helped to restore confidence in the financial system and paved the way for a long period of economic expansion. The lessons learned from the 1929 crash and the subsequent reforms would shape the regulatory landscape for decades to come.